Good afternoon, and thank you for joining our webcast. My name is Ed Steinhoff, and I'm joined today by MIMS Maynard Zabriskie of Morgan Lewis and my Meyer colleague, Margaret Black. We put together some detailed information to share with you on how recent tax law changes can affect tax-exempt organizations. Before we begin, I want to mention a few quick housekeeping items. The slides we'll cover today are available for download on the Meyer website. We are recording the webcast this afternoon, and all phone lines will be muted. An audio replay will be added alongside the slides on pearlmeyer.com in the next few days. If you're having any audio difficulties, you may type in a technical question in the Q&A box that's on your screen in the lower left corner, and a ReadyTalk assistant will help you. And if you have questions for the presenters, please type them also in the Q&A box, and we'll address as many as we can at the end of the presentation. Now let's get started. Our agenda is broken down into 4 broad sections. First, we'll go through an overview of Section 4960 excise taxes, which are part of H.R. 1, originally known as the Tax Cuts and Jobs Act, signed into law by President Trump on December 22, 2017. Then we'll think about Section 4960 within the context of current laws impacting executive compensation for tax-exempt organizations, including private inurement and intermediate sanctions rules. Third, we'll go through several to-dos for tax-exempt organizations in light of Section 4960. And finally, we'll talk about what we're seeing some of our tax-exempt clients considering in light of their executive compensation programs and Section 4960. So to start the presentation, I'll turn it over to MIMS with Morgan Lewis.
Thank you, Ed. The new tax law applies a 21% excise tax on what are called applicable tax-exempt organizations, and it's imposed on compensation payable to covered employees that either exceeds $1 million in a year or is what's called an excess parachute payment, which is basically a payment contingent on separation from service. So let's break that down. We'll talk a bit about who is a covered employee, so which employees does this compensation relate to, what is the 21% excise tax on compensation above $1 million, and then what is this 21% excise tax on separation pay. So first of all, the covered employees. A person is a covered employee if they're one of the top 5 highest paid employees for the year. And as we'll note in a minute, there is a question here as to whether in all of this you use the calendar year or the fiscal year. So we'll explain that a little bit more. But you look at who are the covered employees, the top 5 employees. And there are also some issues on how do you calculate compensation for this purpose. We are expecting guidance from the IRS, so you'll hear us over and over again say, we'll get guidance, hopefully get guidance on this because there are a lot of unanswered questions. But so the top 5 employees, that would be easy enough, I suppose, if you only had to do it once. But what you have to do is for each tax year, starting with the tax year in 2017. So if you're a calendar year, fiscal year, just make that simple. If it's the calendar year, you look at the top 5 for 2017, 18, 19. So each year you look at who are the top 5 highest paid employees. Once somebody is one of the top 5 for a year, then they're considered always a covered employee. So it's a once a covered employee, always a covered employee rule. So you're going to need to keep track of who are your top 5 for 2017, top 5 for 18, 19, and keep a list of them, because if any of those individuals ever have compensation over $1 million, or when they separate from service, you're going to need to determine whether the excise tax could apply. So that's, I think, point number 1 is every tax-exempt organization is going to need to start keeping track of its covered employees. So then after you've determined your covered employees, what is this excise tax? It's a 21% tax on compensation above $1 million. So for your president, for example, if he's a covered employee, presumably is, then if the president has taxable compensation above $1 million, then the piece of the compensation of above $1 million will be subject to a 21% excise tax. And this compensation that's subject to the tax is any compensation that's treated as wages for federal income tax withholding, or amounts that vest in a year, even if they're payable later. So, for example, if you had a 457F plan, it vests in a year, but it's paid later. It's the year in which it vests that you would count it towards the $1 million limit. Now, your 403B plan, your qualified retirement plan, does not count. Those benefits do not count, but anything else that's taxable will count. So you've got the $1 million rule separately, and there's no double tax here. So compensation is subject to one or the other, but separately, when a covered employee terminates employment, you have to look at what payments are contingent on separation from service. So that could be severance pay, would be certainly in this category. And then also, if you have, say, a 457F plan that accelerates vesting, if somebody's involuntarily terminated and they accelerated vesting, then that would be considered a separation pay. So what you have to do is when someone terminates employment, add up all their separation pay and run it through a formula. And I'll talk about the formula. There's a formula to determine is it subject to the 21% tax. If you work with executive compensation for taxable organizations, this formula will sound familiar. If you don't, it'll sound like Greek, so I apologize. But the formula is, the first step is you look at whether the separation payments equal or exceed the person's base amount. And the base amount is 3 times his average compensation in the prior 5 years. So it's basically a 3 times W-2 compensation calculation. If your separation payments are below 3 times your average compensation, you don't have a problem. You can forget about it. If the separation payments are equal to or greater than 3 times the average compensation, then you have what are called excess parachute payments, and the 21% tax applies, but it doesn't just apply on payments above the 3 times limit. It applies on to separation payments above 1 times your average compensation. So basically what you want to do with separation pay is try to keep the separation pay from tripping over that 3 times limit so that you don't have an excise tax issue. That rule does not apply to certain non-highly compensated employees, which is currently defined as people earning less than $120,000. So that might help a little bit, but certainly for your president and your officers, you do have to analyze when they separate from service, do you have excess parachute issue? So you might say, why was this section implemented? And if we could have the next slide, please. Thank you. So there's similar rules. There's a similar rule to the $1 million compensation rule for public companies. So if a public company pays a top officer more than $1 million, the corporation loses the tax deduction for the compensation above $1 million. So they were trying to create some parity here to say, well, a tax-exempt organization, if you pay more than $1 million, you have an excise tax. I guess what they missed a little bit is that if you are a private company, private for-profit, this whole rule doesn't even apply. So they've compared all nonprofits to public companies and trying to create parity. As I mentioned, the second rule that's similar is what's called Section 280G. In the for-profit sector, 280G denies a tax deduction and also imposes an excise tax for payments in connection with a change in control if they exceed 3 times the person's average annual compensation. So that's where this concept came for nonprofits, but in the nonprofit context, it doesn't have anything to do with change of control. It's just whenever there's a separation from service, you can have these the possibility of the excess parachute payments. So if we can have the next slide, please. So who does this apply to? There are a couple of categories, but for purposes of our call, it's really 501. It's usually 501c3 organizations that we're dealing with. That it's really any tax-exempt organization under Section 501A, and then some organizations under Section 115. There is an issue, and you might have read about it, as to whether state colleges are subject to these rules, or state universities. For example, is the football coach subject to these rules? Is he really a state employee, government employee, which would not be covered, or is he an employee of a 501c3 that is covered? So we expect there'll be some addressing of that in the guidance. But for our purposes today, it's 501c3s that we're focusing on. So going back to who is a covered employee, because that's certainly the first step for what we need to be talking about, it's the top 5 highest paid employees. And so in the public company context, you have to be an executive officer to be subject to this rule. But in the nonprofit, it's any employee. So it doesn't have to be an officer. So that's why the football coach, any sports athletic coach who's highly compensated, they could be drawn into being a covered employee. So, and then the questions become, for example, how is an employee defined? We expect that there will be a common law employee kind of analysis. Is this person a common law employee of the nonprofit? Many nonprofits use a PEO to employ the employees, so that you run all your payroll through a PEO. But we think even if you run your payroll through the PEO or through another organization, whoever's the common law employee, if you're a common law employee of the nonprofit, that's probably what the IRS is going to be looking at for employee. As I mentioned, there are questions on how compensation is defined. It would be a lot simpler if they could use the calendar year concept instead of a fiscal year concept, but that is to be determined. There's questions about how compensation paid by related organizations should be taken into account, and there are questions also as to whether, if you have a group of related organizations, does each 501c3 have its own top 5? So if you have 2 related organizations, you could have then 10 covered employees, as compared to if you had all the employees at the level of one of the nonprofits, you would only have 5. So we're going to see that the American Bar Association has submitted comments on for the regulations, and they've recommended that the IRS use kind of a controlled group concept. So you would look at a control group, all related organizations together, and have one group of 5 employees for the whole related organizations. But that's to be determined. If you just look literally at the statute, it looks like each 501c3 has its own set of covered employees. So what companies or nonprofit organizations need to be doing, even if you think you don't have a problem now, you need to figure out each year who are your covered employees, and then keep a list of that, so that at any point in time, 10 years from now, somebody separates from service, you know whether they're a covered employee, and you know whether you need to run these calculations for them. So now we're going to have our first polling question. We're going to ask you some questions and have you submit your answers. Okay? So the questions are, I assume you have access to the polling. So the questions are, has your organization begun to identify who its covered employees might be? So are you a procrastinator? The question number 1 is, no, we have not yet begun this process. So if you're a procrastinator, that's your answer. Or number 2, yes, we have started to identify our potential covered employees. Or 3, yes, we've started to identify who our potential covered employees might be, but we're waiting for further guidance before finalizing. Or number 4, yes, we've figured it all out and we've identified our covered employees. I will say for number 4, if you've done that, you're probably going to have to redo it again when the guidance comes out. So if you could submit your comments, that would be great. Okay, so you can see our response. Good for you. Most people have started at least thinking about it, modeling it out. I think that makes sense to get started on the process. So now I'm going to turn it over to Margaret to continue with our presentation.
Thanks, Mims. So as Mims explained, the identification of covered employees revolves around the concept of the most highly compensated. But Congress didn't define compensation or how to determine that. But the actual 21% excise tax is applied to remuneration in excess of $1 million. We're calling this the excess pay excise tax. And thankfully, the statute does provide a definition of remuneration. Remuneration is defined in the statute as Section 3401A wages subject to income tax withholding, plus amounts that are required to be included in income under Section 457F. It specifically excludes designated Roth contributions and also remuneration paid to licensed medical professionals. Mims is going to get into a discussion about the exclusion a little later. The starting point for remuneration, 3401A wages, is really similar to, but it's not exactly the same as the value reported on Box 1 W-2. There's some adjustments to what is reported in Box 1. For example, like group term life insurance is income reported in Box 1, but it's not subject to income tax withholding. The chart on the screen provides a little more of the specifics on what exactly 3401A covers as your starting point and what it excludes. We're not going to cover those details, but hopefully you can use it as a reference. Moving to the next slide. So since the starting point is wages subject to income tax withholding, which is a concept that is applied to employees, it seems pretty clear that remuneration is not going to include payments to independent contractors or the amounts that are on the Form 1099 miscellaneous. But just so that this won't end up being a loophole, the statute directs the Treasury and the IRS to produce regulations to prevent the avoidance of the excise tax through performance of services as other than an employee. This is going to be confusing to kind of comply with because the Form 990 includes both wages on the Form W-2 and Form 1099 miscellaneous. So it's not going to be business as usual in determining the remuneration. I think it's important to point out here that while Congress under 162M, which Mims discussed, provided a transition rule for certain existing arrangements, there's no corresponding grandfather rule in Section 4960. So let's move to the next slide so that Mims can cover the exception for pay for medical services.
So when Congress was looking at this statute, there must have been some good lobbying, and it makes sense to exclude from the excise tax remuneration paid for medical services. I suppose the argument was, why should you be imposing an excise tax on compensation for medical services? So there's an exception that there's no excise tax on remuneration paid to licensed medical professionals, including veterinarians, for the performance of medical or veterinary services. So we believe that applies both to who's a covered employee and to the remuneration in calculating the excise tax. The scope of the exception, though, there is some lack of clarity. So what is the performance of medical services? Certainly, in a university hospital setting, a physician who's directly providing health care to a patient, that's clearly medical services. But what if it's the head of the department overseeing the medical services of the department? So does his or her compensation for overseeing that department? Is that all medical services? What about supervising interns? What about research? Is that medical services? So there are a number of issues relating to how you determine that. And then also, once you do know what's in and what's out, how do you allocate compensation? Because physicians generally paid not necessarily a certain amount for medical services, other amounts for supervising the department, other amounts for teaching. The compensation is often not broken out like that. So every hospital system is going to be dealing with how do you allocate it? Do you try to allocate it based on time? Are there other allocations that are made for other purposes, say for reporting to Medicare purposes that you could sort of piggyback off of or use some of that analysis to allocate time. So there's a lot. Once we have guidance, there'll be a lot to be done to sort through how do you allocate and determine what are for medical services. Another issue that arises is, as I mentioned before, is which year do you use for determining compensation? The statute refers to the fiscal year. So for a fiscal year, say of June 30, just if you look at the statute, it looks like you have to determine remuneration based on the fiscal year. So you'd have to calculate for each covered employee what is their compensation for the fiscal year. As you probably know, on the 990, a tax-exempt employer reports compensation for the calendar year ending within the fiscal year. So on a 990, it's showing the W-2 compensation. It would be a lot easier if these rules were based on the calendar year, because you're really keeping track of your employee compensation on a calendar year. The American Bar Association comments on the regulations propose that employers be given a choice of calendar year or fiscal year. So we'll see how what comes out from that. We have been modeling it sort of both ways. Some of the modeling because it's easier, just model it on the calendar year, but we've also been modeling it on the fiscal year. And when we model it, what you're looking for three things. You're modeling who are the covered employees, and then in what years are they likely to be over $1 million, and if there was a separation from service, would the separation pay be subject to the excise tax? And we'll talk a little bit later about what you can do about it, but you're looking for what I'll call bumpiness. You're looking for spikes in a particular year that might put somebody in the top as a covered employee for a year, and then drop him back. But if you can avoid him ever going into the covered employee status, that would be better. So you're looking at that, and then you're looking at spikes that cause compensation to go over $1 million in a year. Again, if you can even it out, maybe you can avoid having the excise tax. And then you're looking for situations where you've got a lot of payment contingent on separation from service, maybe a lot of vesting at the end of a term of employment that causes a large payout at separation from service. So you're looking at that. Okay, so now we have our next polling question. The question here is, has your organization modeled the potential financial impact of the excise tax on annual remuneration over $1 million? Question number one is no, we don't have any employees who are going to be paid over $1 million in the current taxable year, so we are ignoring this. Or no, we have not yet begun modeling the potential financial impact. Or yes, we have begun to model it. Or yes, we've completed the modeling, of course, pending any future guidance. So if you could sort of check your answers. So it looks like a lot of people are at least not currently paying at the $1 million level, but also concerned that a large group are concerned that even if you're not currently, you could be in the future, and sort of you need to know what to expect and what you can do to plan around. So Margaret, you want to take it from here?
Sure, Mims. The next topic we want to cover is the new separation pay excise tax. As Mims mentioned, the rules behind the separation pay excise tax were taken from the golden parachute rules under Section 280G and 4999, which penalize companies and executives for paying and receiving excessive compensation in connection with a change of control. However, as we've mentioned before, we're going to bang it into your head, 4960 applies to excess compensation in cases of separation from employment. So the lingo, the definitions in 4960 are taken from very similar terms in Section 280G, if not identical. If you're all familiar with Code Section 280G, you're going to be able to follow the concept here very easily. But generally, under 4960, when payments contingent on that separation from employment exceed an individual's safe harbor, all payments in excess of that an executive's base amount are subject to a 21% excise tax that's paid by the organization. The excess amounts are known as excess parachute payments. Parachute payments, safe harbor, base amount, excess parachute payments, all of these are defined terms in the statute. Parachute payments are payments that are contingent on a covered employee's separation from employment. Those payments are subject to an excise tax if they have an aggregate present value of at least 3 times the individual's base amount. Moving to the next slide. A covered employee's base amount is generally the average of his or her 5 years taxable income from the entity, which typically covers Box 1 W-2s. If an individual was hired during that prior 5-year period, the compensation is averaged over the years of service, and their compensation in any short year, such as the year of hire, is annualized. An employee's safe harbor is 3 times the base amount less $1. When the present value of the parachute payments hits 3 times the base amount, the organization is going to be subject to Section 4960 excise taxes. Parachute payments exclude certain retirement income for medical services, as Mims discussed before, and payments to the non-highly paid employees, those earning less than $120,000. Next slide. So let's go through a very, very simple example that illustrates how separation pay excise tax works. In our example, we've got a covered employee who terminates employment in 2018 and receives a $3 million severance payment on his date of termination. So our first step is to calculate his safe harbor. We gather the W-2s for 2013 to 17 because it's the 5 years prior to his termination in 18. We miraculously find out that these show $1 million in Box 1 for every year. Therefore, when we average his wages for the 5 years, the executive's base amount is $1 million. Simple math, 5 million divided by 5 is $1 million. So you can see that the executive's safe harbor is $1 less than 3 times $1 million, the base amount, or his safe harbor is $2,900,999. Well, that's kind of a tongue twister, but since the $3 million exceeds the safe harbor by $1, the organization is going to owe excise taxes on the amount of separation pay in excess of 1 times the base amount. So that'll be, $2 million times 21% is $420,000. So if it really sounds crazy, unlike the excess pay excise taxes, which is an incremental tax on what is above the $1 million, you drop down to the one-time base amount. It seems kind of illogical, but it's meant to be a penalty. Had the organization paid $1 less, paid the $2,999,999, there would have been no excise taxes owed. Next slide, please. So it's time for our third polling question. Has your organization modeled the potential financial impact of an excess severance excise tax? If you can submit your answers, and we will skip to the results here. A good number of you seem to not have very high separation pay, so it's not going to be an issue for you. About 60% looks like are not going to be impacted by the rule, which is good news. I think Mims and I would suggest having legal counsel make sure that you in fact do not have high separation pay and confirm that. All right, shall we move to the next slide? Okay, we're going to roll up our sleeves now and discuss compliance. A very hot topic. So administratively, how is an organization going to report and pay the 4960 excise taxes? We were a little bit in the dark about this until the summer. In July of 2008, the IRS released drafts of the 2018 Forms 990, and on the forms a question was added regarding whether the organization is subject to the excise tax, so you'll check a box on the Form 990. The drafts indicated that the Section 4960 excise taxes are going to be reported and paid on Form 4720, which is the excise tax return associated with not-for-profits. In August of 2018, a draft of the Form 7020 was released, and it included a new Schedule N for organizations to calculate and report the excise taxes. For those of you who don't know, Form 4720 is due to be filed by the due date for filing the applicable Form 990, which is generally the 15th day of the 5th month after the organization's accounting period ends. The instructions, there was a bit of confusion about, when the excise taxes were required to be paid, but the instructions to the Form 4720 make it pretty clear that organizations are not required to make estimated tax payments for the excise tax. So let's move to the next slide, and Ed's going to try and make sense of how to apply these rules with the already existing rules governing tax exempts.
All right, thanks, Margaret. So I'm sure you're all very familiar with existing rules around executive compensation for tax-exempt organizations, commonly known as intermediate sanctions. And while tax-exempt entities have not historically been subject to overall compensation limits, their compensation can be scrutinized under private inurement doctrine and the excise tax provisions of Section 4941, which applies to private foundations, and Section 4958 for other tax-exempt organizations if they're paying a compensation that is determined to be excessive. So violation of these rules can result in the extreme in the revocation of a charity's tax-exempt status, and or there could also be the imposition of intermediate sanctions, which are penalties that would have to be paid for excessive compensation. The penalties under intermediate sanctions, as you know, can be significant. If an excess benefit is paid or provided to a disqualified person, as that is defined, the person themselves and then those also approving the excessive benefit can be personally liable for excise taxes that range from 10% to 25% of the excess benefit, depending on whether we're talking about the individual who's actually the disqualified person or someone who has approved the excess benefit. And those penalties can range up to 200% if the excess benefit is not repaid to the organization. Establishing a rebuttable presumption of reasonableness is one of the most effective ways that an organization can protect itself from IRS claims that it has paid its executives too much. the rebuttable presumption shifts the burden of proof from the organization and its officers and board members to the IRS, and therefore really shields the organization from liability. And I'll just give a quick review of intermediate sanctions. Again, you're probably already familiar with this, but tax-exempt organizations can create a rebuttable presumption of reasonableness by meeting 3 criteria. First, any transaction involving compensation or benefits must be approved in advance by an authorized body. Typically that's the board of directors or a compensation committee of the board. The board and the committee need to be made up of entirely independent people with no conflict of interest regarding the compensation of the disqualified person. Second, the independent body must obtain and rely on comparability data on total compensation for like positions in like organizations and in like circumstances. And we've listed here some of the sources that typically organizations will look at in reviewing the reasonableness of their executive compensation levels. So look at compensation paid by comparable organizations, which could be actually taxable for-profit organizations as well as other tax-exempt organizations. Look at compensation norms within the location of the organization. They can review independent compensation surveys by nationally recognized independent firms. Written offers of employment can be considered. And then in reviewing the reasonableness of compensation, you do need to look at all elements of the total compensation package. So that would be salary, any incentives that are paid, benefits, and perquisites. And then third, boards must document the bases for their determinations concurrently with making the determination. So these are all areas that you've had to deal with historically to make sure that your executive compensation is reasonable for your executives and directors if they're paid. This just 4960 just adds some additional complexity to what you've already been doing. So having said that, you do still need to take steps to establish the reasonableness of your compensation as you always have in the past. And we do think that there might be a little bit more of a spotlight on compensation that exceeds the $1 million annually, just as a potential element of compensation that could possibly be considered not reasonable. But just to clarify kind of how these two really don't interact, just because an organization is subject to 4960 excise tax does not mean that the compensation will be considered unreasonable. You could still have reasonable compensation and pay excise tax. And on the other hand, if you are not subject to Section 4960 excise tax, then you still could have unreasonable compensation. And so these two groups of regulations are really separate from one another in terms of their administration and what they're trying to achieve. All right, the next slide we start to talk about some of the critical to-dos. And so you can see from what we've covered thus far, really the kind of the main sections that we've talked about are those where it seems like some of you have already started looking at these areas and others will still need to do so. But the first area is to identify those covered employees for both 2018 and 2017. And remember, once an employee has been defined as a covered employee, that status really continues into subsequent years indefinitely. Secondly, once the covered employees have been identified, then organizations are really starting to inventory existing compensation arrangements that might result in compensation that is subject to the excise tax. So looking at any employment agreements that are in place, the base salary levels, annual long-term incentive plan documentation and potential payouts, severance arrangements, just deferred compensation, et cetera. All those elements of the current compensation package should be reviewed to really understand to what extent you might be subject to excise tax payments. Third, organizations, as we talked about in one of our polling questions, really should start to estimate the annual financial impact, if any, on the organization of the excise tax payments for the annual compensation in excess of $1 million. Fourth, determine whether any adjustments should be made to current programs to either reduce or eliminate the payment of the excise tax. And it's probably an obvious comment here, but we certainly don't want Section 4960 to drive our executive compensation program design. You want to have the mission of the organization, your executive attraction and retention issues really driving the design of your programs, but I think it's important to be aware of the excise tax implications if there are any, and just factor that in along with the other elements of the design of your programs to make sure you understand what those implications are. And then kind of the last thing to do in terms of the current programs is in anticipation of any terminations that might be coming up, evaluate whether any excess parachute payments are likely to be triggered. As Mims has said, and Margaret as well, we're still waiting for some additional guidance in a lot of these areas. But in the meantime, for the excess parachute payment piece, we believe that really looking at the Internal Revenue Code Section 280G golden parachute provisions will provide some reasonable guidance in helping to figure out what would be considered an excess parachute payment and what would not be. So all of those areas are really kind of looking at your current program design and what the potential liabilities might be there. The last item on this slide is to consider how these new rules will apply when structuring compensation arrangements going forward. So those first 5 areas are more kind of retrospective and based on current state. The last one here is really thinking about how you might think about the program design going forward. All right, now on the next slide we have our fourth and last polling question. So this question is, has your organization made any changes to its ongoing executive compensation programs or its programs which provide for payments upon separation of service because of the new excise taxes? So the options here are 1, no, we don't plan to make any changes. 2, we haven't started to make any changes, but we are contemplating making changes. Third, yes, we've made changes to our annual executive pay practices. Fourth, we've started to make changes or are going to make changes to our executive severance provisions. And fifth, we're going to make changes to both annual executive pay and to executive severance provisions. So we have some responses here. Let's take a look. Looks like most of you, about 2/3, do not plan on making any changes to your programs. Could be related to the earlier feedback that you don't anticipate being kind of covered by the excise tax provisions. Some of you are contemplating, about 1/3 are contemplating, and looks like one of you has made changes to annual executive pay. One has made changes to both annual pay and to executive severance provisions. So appreciate the feedback there. On this slide, we're going to talk about what we're seeing some of our clients looking at in terms of changes to program design for kind of the immediate future. I think, Mims, you were going to talk about the first item here.
Sure. So when you do the modeling, as I mentioned, you figured out who your covered employees are, do a timeline of what years are they going to likely be over $1 million, or if they had a separation from employment, would they have a parachute issue? So you can look at, as I mentioned, years in which there might be a spike in compensation. And what you can do is, if that spike in compensation is caused, say, by a 457F plan, you may be able to accelerate some of that compensation into an earlier year to smooth out the compensation, so it you either always stay within under the $1 million limit, or you limit the amount of compensation that would be paid if the employee terminated employment. You have to be careful to comply with the Section 409A and Section 457 deferred compensation rules, and you also want to think about if we accelerate vesting, then we've taken away one of our retention tools with our executives. So those are two things you think about before you just automatically do it. But we do have some nonprofits have set up sort of retirement programs where a fairly large account is building up in the 457F plan. It's paid out at the end of the term, or it's even further deferred, and then if the person is involuntarily terminated, it would be accelerated. So that can cause a large payment in a particular year that could trigger one of those excise taxes. So Ed or Margaret, I think you were going to talk about the life insurance.
Yeah, I think on the life insurance, I think this has hit more of the press than we've actually seen. But many nonprofits are considering using collateral assignment split dollar life insurance as replacements for deferred compensation arrangements. This is where it's a collateral assignment split dollar life insurance are a somewhat technical animal, but it can in fact be a replacement for deferred compensation. I think it was written up in the press as some coaches of some teams were putting these in place, and so there's been a lot of chatter about that. I haven't seen as much myself with clients, but I know that is being talked about.
We're also seeing.
Go ahead.
We're also seeing some of our clients looking at their qualified retirement benefits and making sure that they are maximizing the value of those qualified benefits because they are not included as defined as compensation for purposes of Section 4960. So looking at whether you have 401k, 403b, just the qualified plans, and making sure that you're providing as much as you can to the executives within those plans. And then lastly, organizations are looking at their executive severance provisions. What we've seen a lot of publicly traded companies doing in the last few years is, in order to avoid the excise tax under Section 4999, they have put a provision into their executive severance programs and agreements that say that we have the ability to reduce severance payments to a level that will not trigger any excise tax payments. And so we're starting to see tax-exempt organizations looking at that language and determining whether they also want to provide that ability to really unilaterally modify or reduce compensation in order to avoid the excise tax under Section 4960. And that is the end of our presentation. We do have about 9 minutes here for questions. We did have 2 questions come in, and I'll just read the question and then we can provide a response. The first question is, what about deferred amounts not subject to Section 457, for example, deferred compensation from church organizations? There's some language in the statute that would seem to allow us to include this amount when paid versus when not subject to a substantial risk of forfeiture.
Mims, do you have any thoughts on that?
sorry, I was on mute. I'm sorry, Ed. I was, since it wasn't in front of me, what was the question about substantial risk of forfeiture? I apologize.
Oh, no problem. It says, what about deferred amounts not subject to Section 457? There is some language in the statute that would seem to allow us to include this amount when paid versus when not subject to a substantial risk of forfeiture.
Well, the 457F, I think, is pretty clear. That's the one that has to be subject to a substantial risk of forfeiture. I think that's, I think it's pretty clear that that's going to have to be included when it vests. I know there's a question because of I think the tax withholding. There's some issues around tax, when you have to withhold tax, or whether the 3401 applies to 457F. So again, subject to guidance, we think the better interpretation at this point is that for 457F, when there ceases to be a substantial risk of forfeiture, you need to be including it. But
this is a very technical question. I think it's relating to amounts not subject to Code Section 457F. So we'll go ahead and we'll research this. I don't know that either of us know it off the top of our heads at this particular moment, but we will take a look at it and get back to you.
Yeah, there is a question on 457B plans that definitely needs to be addressed in the guidance, because it looks like when you defer into a 457B plan, it doesn't have to be included, but when it's paid from a 457B plan, it may be subject to may be considered remuneration for the $1 million limit. So that's an unclear point.
Yeah, that was exactly the next question that we received, was whether or not 457B plans are excluded also, and also a question about 415M excess benefit plans. I don't know if you have any thoughts on that.
I don't think there's any. Yeah, there's no exclusion for the excess benefit plans in the language of the statute, at least. So, I mean, that all goes to, you can do your planning. I would just try to model it the most conservative way, knowing that you'll have to do your sort of final look back once we have more complete guidance.
Right.
Anything else? I don't have access to the questions, so is there anything else?
Yeah, no, those are the two questions that we had, so I think we're all set. Thank you very much for joining us. As I mentioned, the presentation and the recording will be on Pearl Meyer's website. If you, I know we went through a lot of information here. If you'd like to use it as a reference, you can find it there. Thanks again.